they're looking at public sentiment long before they get on the airplane to come out to your bank to start that examination. And they're determining whether you did something right or wrong from that perspective. So they see a heat map of the marketplace. They see a particular blight, a particular tall bar. They look at the companies that are producing and selling that product into the marketplace. They find the one that's producing the most harm. They execute an examination into that institution and they come in with receipts. But yet I can tell you today where the most risk is in the marketplace based on consumer sentiment today. And that's what the CFPB is looking at.
On this episode, we're talking with Jim McCarthy of regulatory consulting firm McCarthy Hatch. Jim shares his perspective on the trends in consumer financial regulation stemming from his time at both the FDIC and CFPB. We cover the impact of fintech and regulation on financial institutions and the strategies he's seen successfully employed in response. Also, Jim shares how leading institutions are leveraging consumer sentiment data to stay one step ahead of compliance risk and fines. Jim, thanks for being with us today.
Hey, I appreciate being here. This is fantastic. If you want me to introduce myself, I've been in consumer finance my entire life. I cut my teeth in community banks and credit unions. I became a banker when they issued ashtrays as one of your issuances when you started, your card holder, your pen holder, and your ashtray. So it goes back quite a ways. Typewriters that used to do crazy things. And then I progressed and I actually worked at the national level for the public sector at the FDIC. And then I am a founding member of the Consumer Financial Protection Bureau. So I was out in Washington, D.C. building the Consumer Financial Protection Bureau along with a great, wonderful group of people. And so that catapulted me to what I do today, which is help financial institutions understand who their customer is and how to listen to their customer in an attempt to mitigate or at least identify risk.
So let me ask you just a little bit about the kind of the founding of the CFPB coming out of Dodd-Frank. This was what, circa 2011, 2012, somewhere in there?
10. Yeah.
10. Okay. What did you really see? Again, with the bent being on the consumer side, what was really the intent or the problem that you saw the agency was trying to solve it, and maybe if there was any gaps between what that ideal was and what it actually turned into?
Sure. So it's really it really comes down to this, right? So prudential. When I use the term prudential regulators, I'm referring to the FDIC and the OCC. The groups that used to monitor the consumer financial business within chartered financial institutions, right? So the prudential regulators, previous to the CFPB, had a method in that they deployed in monitoring harm in the marketplace. And their method of identifying that harm was to examine banks and institutions, do a sample and an audit top to bottom, side to side, and issue a warning or an enforcement action against that institution, move on to the next one, move on to the next one. The thing that's interesting is the OCC and the FDIC had ownership of the consumer financial regulations, okay? The creation of the Consumer Financial Protection Bureau transferred the ownership of those regulations that we know of as consumer financial regulations from the OCC, the Federal Reserve, the FDIC, over to the CFPB. So what we have is a fighting chance for unity and cohesion amongst the regulations. And so one of the things that I remember as a community banker in this country is that if I had two regulators, a state regulator and a federal regulator, or two federal regulators interpreting the same regulation in a different way, it was very frustrating for me. Now, with those regulations under one roof, they could begin to talk to each other and synthesize with each other, and they could begin to work better together. And then there are some changes in terms of how the CFPB engages the industry in terms of how it looks for consumer harm. But the big change was the ownership of those regulations and the method in which the CFPB engages the marketplace in order to identify consumer harm. Those are the big areas that changed.
One of the impacts, and we've talked a lot to other guests about this, was how much of, particularly on the consumer side, how much of financial life has flowed out of the traditional banking channels into fintech, into areas that aren't even considered to be finance companies, but yet seem to be doing things that look and smell like personal finance. How much of regulation do you think is either the cause of that, or has missed the boat, or to a certain extent there's a regulatory flight for some aspects of people's personal financial life?
Sure. So I applaud what's happening from an innovative perspective. I think we share that feeling. So I totally applaud what's happening. I kind of see what's happening in the buy now, pay later and the advanced wage access programs, and some of the other, they look, smell, feel, talk like a bank, but they're not a bank. And where do the regulations fit or don't fit? I'll just say this. A very good friend of mine and one of the best consumer financial attorneys in the country is Eric Goldberg, Ackerman law firm out of Washington, D.C. And Eric Goldberg had his hand on the pen of Regulation E Subpart B, which was back when I was at the CFPB, and we included the money transfer industry into Regulation E, which it previously was not included. Okay? So the reason I tell that story is this. These regulations are not perfect. Innovation is happening at a very rapid pace. And because there is a product or service that has reached a level of popularity that people are using it, and then we run into a speed bump where some people got harmed, doesn't mean that we have to burn the house down. It doesn't mean that it's not repairable. An example of that is Venmo, PayPal, and advanced warning Zelle. There's an argument going on right now, and we saw the director drop a new rule this week that says, or last week, that says that they're going to cover them as a regulator now, which they hadn't before. One of the problems with Regulation E is it didn't cover those transactions that are taking place adequately in that Zelle, in that person-to-person payment market. So in an interview with Eric Goldberg, I became critical of Regulation E and said, is it even a good regulation? Is it not modern enough? Is it not pliable enough? And his argument back to me was, this is natural for this to happen. Innovation happens, new ways of moving money, new ways of transacting business. It's accepted by the marketplace. The consumers have accepted it. Let's just make sure that the consumers are protected in the way that we intend them to be protected, and cover those transactions where they can be covered. I guess I think it's a beautiful marriage between innovation and technology, the way that interacts with the existing banking industry, and how regulations slowly keep up with that.
There's also an element of, the traditional banking channels are under stress, I guess would be a good way to look at it. I mean, certainly under threat of stagnation. I mean, you look at like the de novo bank creation is effectively zero. It's not zero, but it's pretty close to it. And so it's this idea of it's a dinosaur industry. It's just going to be about consolidation. We had a guest on who does M&A, who basically made the assertion that any institution that has less than $1 billion of assets is effectively for sale. That's the market we live in today. Now that's not a universal opinion that's a good thing, even within the Fed from that standpoint. What do you think about that from a regulatory standpoint of we're preventing innovation within regulated industries, and so you see consumer preference, other things kind of not necessarily going to something that's going to be better for them or more trustworthy, but something that's maybe easier? or
Right.
presented in a way that is accessible to them that frankly regulations stifle that in traditional institutions.
Right. And it's be careful what you wish for, or what goes around comes around. So I have a number of clients that have asset sizes of $1 billion, up to 10 billion at the beginning of the CFPB coverage. And we have this conversation on a regular basis, right? So what is happening? What I would like to say is that it the let's call it the fintech market. Okay, let's just put a circle around it and call it the fintech market. Products and services that are offered by non-banks. Okay, maybe some of them in partnership with banks, but generally offered by non-banks. That market out there that seems so attractive and the banks seem to want to keep up with is a scary market. And the security, the privacy, and the confidence that you have in your consumer financial products and services sometimes doesn't feel as solid in that market yet. And so when I say be careful, what we ask for is banks might actually have a product or service that becomes the most popular going forward because it represents the most security. It represents the most confidence you can have with your consumer, uh, with your money, and then let the banks get innovative in terms of how they offer and people can access and move those products and services. But I think rather than banks really saying we need to be more innovative and more out there in this market, let's see what that market does first. And the Zelle example is a perfect example. As well as I do, the large banks own Zelle through early warning system. That's an experiment to say, hey, let's not lose market share to this wonderful product that Americans are using. And we're kind of seeing that kind of happen right now. And I think it was a beautiful project, and I think it's going very well, and I think it's going to continue to go well. So I'm a big fan of the banks. I think that the security that they offer still stands for something. And I think that its value will increase over the next 5 years while innovation continues to scream forward, until we see some solid regulations in that space. And 1033, which we'll talk about, is a gigantic step forward.
So on the regulatory and compliance side, I mean, you're in the business of providing advice and consulting to institutions when they're looking at that. Particularly for the smaller institutions, what are typically the big gaps or the big hurdles that they're dealing with, and which way do you point them and how to address that?
Yeah, I think it's real simple, right? So I try not to I try not to complicate this. We are the product of our upbringing, our history. We as bankers are the product of what, I can take you back to the banking school that I went to in the 80s, right? And I started to learn banking then, and banks become bigger banks, and now we've got Wells Fargo and a couple other ones that used to be smaller banks. So we all do the same thing when it comes to risk identification and mitigation. And one of the things that I think, that I would advise, that I would advise banks of, I think, a more acceptable asset size below 10 billion. I think I would say be agile, right? Understand that when you build out a risk control system, you set controls or mousetraps to try to find problems. It is not always obvious and conspicuous when that problem goes through your operating systems that it's creating problems. And what do I mean by that? You could have perfect compliance through your controls and still come in and have a massive violation, by a regulator for, some federal regulation. How does that happen? Well, it happens because we stopped listening to the customer in some cases, and that's why I say 10 billion and less still listen to their customer efficiently and effectively. But the biggest thing I can say to you is don't just look at the controls, look in between the controls. We work with the top 5 banks, and we work at the top level of the banks in the country. What we do is we take what the consumer is saying about that institution, and we move that through a model that we built that looks at it from a regulatory perspective, and we give that institution a risk profile about where in their institution they could potentially have risk. Okay, well, how can a smaller bank implement something like that? Well, the way that you implement that is look at your consumer sentiment data independently, not as though you've done something wrong. If it's a complaint, ignore, be agnostic to its response, whether it's right or wrong. Look at what your consumers are saying on a regular basis and use their opinions to double check your controls that you have in compliance. And that's really where we begin touching the customer again. And I think going back to what you were talking about before in terms of banks and mergers and acquisitions and sizes, with the introduction of AI, you will see very rapidly, and I can tell you because I'm on the front end line of this, you will see the large banks be able to communicate and understand with their customers more efficiently, like a community bank, than ever before. It will, the one place that AI will help the banking industry is listening to their customer through the transactions and through their correspondence with the institution, through social media, complaints, and other things. So the best thing I could say to community banks is look between those controls. You build the best control environment in the world you want, but if you're not listening to the customer, you're going to miss some opportunities. Navy Federal Credit Union recently was hit. Navy Federal Credit Union had controls set up for overdrafts like any other bank has set up for overdrafts. But they had that positive pay. They had that positive overdraft situation that cost them multi-millions, tens of millions of dollars. And that didn't show up in their control system. Why? Well, it wasn't flagging. But had they listened to their complaints, which I was reading in the public space, they would have seen that they have a huge issue. Their customers are clamoring that they have problems. And so they didn't marry the controls with the customer's voice, and they lost a little money.
So have you found that this idea of customer satisfaction, whether it's NPS or complaint scores or BBB ratings or anything like that, that's completely divorced from a control standpoint, meaning like that's the realm of marketing, that's customer experience. That really isn't an operational or risk management concern. Are those two typically seen as like there's a wall between them, or it's just not taken serious enough?
Yeah, so that's a great question, and I'll go to that real quickly. The reason I talk about this and the reason I think that this is important is because when I was at the Consumer Financial Protection Bureau and had the great pleasure of working with those people to build that out, I know and understand how the Consumer Financial Protection Bureau monitors the marketplace, hence the banks or other non-banks. Right. And the way that the Consumer Financial Protection Bureau monitors the marketplace is they don't go in like the prudential regulators to do an examination to figure out whether you're doing something right or wrong. They're looking at public sentiment long before they get on the airplane to come out to your bank to start that examination. And they're determining whether you did something right or wrong from that perspective. So they see a heat map of the marketplace. They see a particular blight, a particular tall bar. They look at the companies that are producing and selling that product into the marketplace. They find the one that's producing the most harm. They execute an examination into that institution and they come in with receipts. So that's the difference, right? So therein lies the rub. You're right. No, the banking industry does not look at the sentiment issues that I call sentiment issues in line with risk. But yet I can tell you today where the most risk is in the marketplace based on consumer sentiment today, and that's what the CFPB is looking at. Now, sure, we're going through an administrative change in that environment will change, but generally speaking, it's a 21st century regulator that uses data to as a precursor to how they engage the marketplace, much more efficient.
So on that vein, talking about regulations and data, you had mentioned 1033, the quote unquote open banking rule that's kind of come out from the CFPB. How do you see that, as at least as far as the final rules that have been published this year and where that's going, and how are you advising clients as far as compliance and how to think about it from a strategic standpoint, et cetera?
Yeah, it's something that I've followed since the beginning. I can remember being involved with the Sabrifa hearings where we were talking about what we would do and wouldn't do, what's right and what's wrong, and we bring it all the way to the rule, right? So for those of you listening that might not know, 1033 is the open banking rule. It says you can unplug your data from a bank and take it where you want to take it. The one thing that 1033 did, which I thought was brilliant, was it created the technical playground, the security, the formatting of the movement of that data is governed under the rule. So it can't be just willy-nilly moving around the country. It has a protocol that it must follow. There are only certain institutions in the country that can put together a network that will meet those requirements. See your platform providers, right? So 1033 is the beginning of taking away one of the anchors that the banking industry has had for years, and that is the checking account, right? So used to be safe deposit boxes when I was growing up, and then it moved to the checking account. Checking account anchors customers at banks, plain and simple. It always has. One of the reasons it has is because of how difficult it's been to move. Okay, so what's going to be the next anchor? Well, I alluded to it earlier. I think the next anchor is going to be security and safety of your personal financial information and of your money. I think that's going to be the next anchor of the banking system, to stand up with those big pillars in front of them again that display strength in the marketplace. And I think that's their market advantage.
So what advice are you giving your clients from this standpoint? If they're seemingly having this moat being taken away from them from the transactional aspect of a deposit account like checking account and everything that kind of goes into it, particularly from a household finance standpoint. How are you advising them to position themselves to take advantage of this position of security and trust?
Compete. Be the best that there is, and sell what you're giving away for free. You're giving away safety and security. You're giving away a peace of mind. There is something you as a financial institution bring to the marketplace, and that's stability and strength. And make good decisions. Listen to your customer. Become competitive. Make your customers want to bank with you again. Give them a reason. And don't overboil that ocean. Just simply begin to talk about it. Talk about your strength. Talk about your security. And point out the fact that fintech market out there is still settling itself down, and there's still a lot of concerns out there. And stand up in the light of security and stability, I think is the best thing. But competing is going to be where that is going to land. And we'll see a lot of mergers and acquisitions where banks are going to be reaching for that competitive edge, where another organization has really shown that they can deliver that effectively.
So as you said, we're at a transition period going into a new administration, and we'll see which way the wind blows, but it likely looks like an area of less regulation, or at least less heavy-handedness from the federal standpoint. How are you, what's your view of that? Do you agree, disagree? And how are you advising clients to kind of prepare for that, for at least some kind of change?
Yeah, sure. I'm an odd duck in my industry. And I'm an odd duck in the sense that I put it out front that my goal in life is to improve the human condition. Hard stop. And I've worked my entire career to do that. Building the complaint space at the Consumer Financial Protection Bureau resulted in over $21 billion worth of penalties where consumers received restitution. So I feel like I'm pushing that all the time. So I'm I'm biased when it comes to what happens to particularly the Consumer Financial Protection Bureau with the changeover of the administration. But I also have to remind myself that Rohit Chopra, the director of the CFPB, was appointed by Trump in 2017 to head the FTC. So I'm passionate about letting people that have lower incomes keep all or as much of their income as possible. And predatory fees and interest rates and deceptive loan practices into those marketplaces are not something that banks want to happen. No one that's a good player on the marketplace wants that to happen. And I think the CFPB has done a great job of moving bad actors off of the playing field in the consumer financial marketplace, aka ITT Technical Institute. And we could go down the line. And so I think it's needed. I would like to see it stay, but I also am aware of the fact that we're changing administrations and regulation is seen as this horrible thing. But I think we need to protect the American consumer. And there will be a flight to banks over the next 5 years on this new regulatory environment, for sure.
Okay. Interesting take. We'll see how it plays out, and we'll see if anybody shows up with donuts for the first day in January. So, Jim, this is a great conversation. Thank you very much for sharing with us. If anybody's interested in more about you or your firm or your services, where can they get more information?
Yeah, it's great. Well, we have, if it's okay with you, we have a podcast. It's on all the platforms. It's called Financial Forward. We interview all these people that I've been talking about, and we talk about interesting subjects. I hope to co-broadcast this podcast so that we can partner together, because I want my listeners to listen to yours because it's extremely valuable. Yeah, I can be reached at McCarthy-hatch.com. And of course, I'm on LinkedIn. So thanks for this opportunity. I appreciate spending this time with you.
And we'll put links to all of that in the show notes. Jim, thanks
Sure.
again very much for being with us today.
Yeah. Thank you very much.